The Japanese yen continues its race to the bottom in a tense sell-off as every pip brings the Japanese closer to a direct currency intervention. The euro and pound remain under the pressure of political uncertainties. The yields rise as well on Japanese drama, while Amazon just rallies to a record high and Micron fails to impress its investors with its current quarter revenue forecast. So we have a lot to talk about today. Tune in. This is Swissquote's Daily Market Talk. So the sell-off in Japanese yen extended yesterday, sending the currency to the lowest level since 1986, the year of my birth, against the US dollar, and to the lowest levels against the euro. The Euro JPY is now flirting with the 172 level, while the dollar yen is consolidating gains above the 160 level. The only thing that prevents the Japanese yen from a further fall is the direct intervention risk, that threat. But other than that, the yen deserves to lose more blood. Now, 1 year risk reversals, which show how traders feel about the Japanese yen over a longer period of time, show that, well, they're still kind of excited about the Japanese yen compared to the US dollar, but that excitement is fading faster than a New Year's resolution as the Bank of Japan keeps delaying its rate hiking plans, while the US Federal Reserve is delaying its rate cutting plans. Now, the Bank of Japan is expected or is obliged to give a clearer roadmap regarding how it will reduce its bond purchases in its July monetary policy meeting. They might also well be obliged to hike the interest rates in July, given that the pressure on the Japanese yen won't ease until concrete steps are taken on the monetary policy front. So this is why we see the Japanese 10-year yield rise fast this week, because everyone, including Mr. Ueda and his team, know that a currency intervention from the Japanese authorities will be nothing more than just another morphine injection to this market. It can't be giving anything more than just a temporary relief to the suffering Japanese yen. Now, elsewhere in the currency markets, the euro remains under the pressure of the French political shenanigans, of course. The euro dollar is getting comfortable below the 1.07 psychological level, and I think that the downside pressure will be rising from now to the end of this week, as many investors out there will choose to exit their long exposure to the single currency before the first round of the legislative election that's due this weekend in France, which will likely confirm the French preference for Marine Le Pen's quite right political party. Now, sentiment data due this morning from the Eurozone would also put some concrete numbers on the European political worries. Across the channel, while the British pound also comes under a selling pressure these days, cable cleared an important technical support at yesterday's trading session as it slipped below the 150-day moving averages and below the major 38.2% Fibonacci retracement on April to June rally, meaning that the pair cable has now stepped into the medium-term bearish consolidation zone, which makes it vulnerable to a further fall against the US dollar. The next support zone sits at 125.60, 125.80 region, the zone that shelters the 200-day moving average and the 50% Fibonacci retracement. We could see the pound bears take aim at this range, really, given that the general election in the UK is approaching fast, but in the UK, there is not much doubt about a Tory washout in the next elections. This being said, there is a problem still that the Financial Times summarizes very well in just one sentence. They say, Labour and the Conservatives are on course to register their lowest combined vote share in a century, according to pre-election polls. And that will leave the country with obviously a lot of political uncertainties moving forward. Obviously, Nigel Farage is fun, he's very fun, but at limited dose. Now, far away from home, the Australian dollar is among rare major currencies that challenge the US dollar's strength these days after the Australian inflation hit the 4% mark in May, leaving the Reserve Bank of Australia those with no more energy to fly, really. But overall, the weakness that we see in euro, in pound, and Japanese yen these days sent the US dollar index to the highest level since the beginning of May, and expects more inflows into the greenback before the French election weekend. Now, one thing that could eventually derail the US dollar's positive trajectory this week is economic data. So due today, the US will reveal its latest GDP update, and tomorrow, on Friday, we will have a look at the core PCE index in the US, which is the Federal Reserve's favorite gauge of inflation, as you know. Now, what the Fed does want to see is a reasonably softer economic growth in the US combined with softening inflation. The risk is seeing a softening growth with insufficient retreat in inflation. Now, good news is that the inflation component in the GDP report of today won't matter much, as inflation has actually started to ease after an early uptick in the first quarter of this year. So we won't have the full picture to speculate on new Federal Reserve rate cutting scenarios before tomorrow's PCE release. But in all cases, I think that the rising bets that the Federal Reserve could cut the interest rates by 300 basis points in the next 9 months is, well, quite overdone. If you haven't heard that rumor just yet on the news, it won't happen. It won't happen unless we see a big problem in the US economy that no one wants to see. Now, in the equities and bonds space, the US 2-year yield was slightly higher yesterday. The 5 and 10-year yields rose to the highest levels in 2 weeks despite a good 5-year bond auction in the US as the rising Japanese yields rose anxiety among bond investors, but not among equity investors, because the S&P 500 and Nasdaq 100 closed slightly higher yesterday's trading session thanks to a late session rally as Amazon hit a record high following a 3.9% rally and reached the $2 trillion mark in terms of market cap for the very first time in history after announcing its plans to launch a Temu-like discount section that ships goods directly from China. So Temu's owner PDD, Pinduoduo, plunged below its 50-day moving average level on Amazon News, and other than that, Rivian rose 23% yesterday after Volkswagen said that it will invest $5 billion into a joint venture to produce the next generation of electric vehicles with the struggling Rivian, while Micron fell 8% in late trading despite announcing better than expected earnings and better than expected revenue because the revenue forecast for the current quarter just met the analyst expectations of $7.6 billion for the current quarter. Anything less than absolutely fantastic is not good enough when your share price got multiplied by 3 in just about 18 months. And finally, well, FedEx jumped 15% yesterday, and the European Novo Nordisk, the biggest European company, mind you, that sells, well, weight loss drugs, hit a fresh record this week after announcing that it finally got the approval from Chinese authorities to sell its weight loss drugs to the Chinese, who could simply eat their own delicious and absolutely healthy diet instead of eating the fat American food and, buy this stuff to lose weight. But hey, one person's misery is obviously another's happiness, right? So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reaction, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.